a retirement strategy that can generate a 9% yield? We'll get to that in a second. But first, you've spent decades saving for retirement. All those early mornings, the late nights, diligent contributions to your 401k or IRA. But now that you're getting close to the finish line, you're facing the single biggest fear every retiree has. How will my money actually last? And what's the best way for me to turn that lump sum of money into an ongoing paycheck in retirement? So you look at your nest egg, you see the historically low yields on so-called safe investments, and you do the math. I mean, the 4% rule, which was once kind of the gold standard of retirement planning, it feels like it's stretching pretty thin in a world of stubborn inflation, ongoing market swings, all those things. So you're worried you'll have to compromise on your retirement dreams, maybe cut back on travel, or even worse, maybe outlive your savings. But what if there was a specific rules-based strategy that targets yields in the high single digits, 8-9%, potentially maybe even higher? A strategy that creates a steady cash flow, giving you the income you need without constantly having to sell off your precious principal. In this video, I'm going to walk you through that exact strategy step by step. And because no investment strategy is a magic bullet, I'll also show you the one specific market scenario where this strategy typically underperforms so you get the full unvarnished picture. All right, let's be real about the problem we're trying to solve. The world of retirement income, it's changed a lot over the course of the last several decades. For our parents' generation and before that, the plan was pretty simple. You retire with a pension, you add in Social Security, and you keep a good chunk of savings in safer investments like bonds or maybe even CDs that reliably paid 5% or more. And that was a recipe for a very comfortable, low-stress retirement. Now we kind of fast forward until today, and obviously that landscape is almost unrecognizable. Pensions are a rarity. It's very rare that any companies offer new pensions. And the reliable income from bonds has been squeezed for over a decade. Now, rates are off their absolute lows, but still, most high-quality bonds yield somewhere in like the 3 to 5% range. So trying to live on that kind of income by itself would require a portfolio size that's out of reach for most people. In fact, many financial planners now suggest you might need a nest egg of well north of $1 million to ensure a comfortable retirement without a pension. Although this number can obviously vary widely depending on your lifestyle and your financial plan. So this has forced retirees really kind of onto a tightrope. On one side, you have the relative safety of bonds and CDs, which, I mean, after you account for inflation, they might barely keep your head above water. On the other, you've got the stock market, which offers growth, capital appreciation, but comes with gut-wrenching volatility. Watching your portfolio drop 20% doesn't feel great when you're 40. It's absolutely terrifying when you're 65 and you need that money for your lifestyle. So this is the core anxiety. Retirees, they're caught between the fear of running out of money and the fear of losing it in a market crash. So the traditional 4% withdrawal rule, basically where it says that you can withdraw 4% of your principal every single year and adjust for inflation every single year thereafter, and that will ensure that you have enough income coming in and you won't outlive your money. It creates a feeling of scarcity, not abundance. Does that sound familiar? Have you run the numbers and felt that knot in your stomach? Well, you're not alone. I mean, this is the central challenge for millions of retirees today, and it's why we need to look beyond the old playbook. Well then, what's the alternative? How can we generate a meaningful income stream? Something that targets that high single-digit range without making speculative high-risk bets. The strategy is called writing covered calls. Now, before you click away because that sounds complicated or like something only Wall Street pros do, stick with me. This is one of the most powerful but misunderstood tools for income investors. Really, at its heart, the concept is incredibly simple. Think of it this way. You own a house and you aren't planning to sell it right now. So to make some extra cash, you decide to rent it out. You still own the house, it's still your asset, it's still appreciating, but you're collecting rent checks. A covered call works almost exactly the same way, but instead of a house, you're using the stocks that you already own. You're essentially renting out your stocks to another investor for a short period of time. The rent you collect is called a premium, and it's paid to you upfront in cash, no matter what happens. This premium is what generates that high income stream, targeting the high single digits or maybe even beyond. Now, this strategy has two simple parts. First of all, you own shares of a stock, usually in blocks of 100. Second, you sell something or write something called a call option against those shares. A call option gives somebody else the right, but not the obligation, to buy your shares from you at a set price, which is known as the strike price, before a specific date and time, at which point that option expires. In exchange for giving that other investor that right, they pay you that cash premium. You get paid immediately. If the stock price never goes up to that set price by the expiration date, the option simply expires. You keep the premium, you still own all of your shares in that stock. Then you can turn around and do it all over again, quarter after quarter after quarter, collecting more and more rent checks. Now, this process helps you monetize the stocks you already hold and turn them into income-generating assets. All right, let's move from the what to the how. This is a rules-based approach, and the key is sticking to the process. The first step is selecting the right stocks. This is the foundation, and it's critical to make sure you get it right. This isn't for speculative meme stocks. This isn't for high-growth AI or tech stocks. The ideal candidates are stable, high-quality blue-chip stocks and ETFs, the kinds of investments you'd be comfortable owning for the long run anyway. So think of large established companies with strong balance sheets, consistent earnings, and hopefully a history of paying dividends. So that dividend gives you a base layer of income, and the stock stability makes the option income even more predictable. The goal here isn't to hit home runs on stock price. The goal is to generate consistent cash flow, and the capital appreciation in the stock price, that's icing on the cake. The second step is you have to own at least 100 shares. And this is why it's called a covered call. Your obligation to sell the stock is covered because you already own it. In the options world, one contract represents 100 shares. So to sell one covered call on, let's say, Coca-Cola, you first need to own at least 100 shares of Coca-Cola. To sell 10 contracts, you would need 1,000 shares. Okay, so this is an important detail, as it means the strategy can require a good amount of capital to get started with individual stocks. And the third step is to sell a call option with a specific strike and date in mind. Once you own the shares of the stock, you can write or sell the call option right from your brokerage account. You just need basic options trading approval, just basic, okay? Because they're covered calls. You're not writing calls on stocks you don't own. So it's entry-level options trading approval. And you'll have to make two key decisions. The first one is the strike price. So this is the price you agree to sell your shares at. You'll be able and you'll want to choose a strike price that is above the current stock price, also known as an out-of-the-money call. So for example, if your stock is at $50, you might sell a call with a $55 strike price, 10% above where it's currently trading. Choosing a strike further away, you can do that, but it's going to pay a smaller premium, and it's, also makes it less likely your shares are sold, but at the same point in time, that smaller premium means that you are generating less yield. A closer strike is really going to pay more, but it increases the chance of your stock being called away. So a balanced approach is often a strike. I like to target close to 10% above the current price. You can go down to 5%, but 10% is normally where I target with my clients. The expiration date, that's the second thing. So this is how long the contract lasts. For a retirement income strategy, selling monthly options, typically 30 to 45 days out, is a common and effective approach. It strikes a good balance for generating regular, predictable cash flow. But that at 30 to 45 days is also incredibly laborious. Because every 30 to 45 days, you're going to have to monitor those and do new ones and write new ones and so on and so forth. Maybe waiting a little longer, like 2 to 3 months, is really the sweet spot, in my opinion, for hitting that high single-digit yield rate. Step 4, collect the premium instantly. So the moment you sell the call, the premium or the cash is deposited right into your brokerage account. And you keep this premium no matter what happens next. I mean, no matter what happens to the stock. This is your income. If you sell a call on your 100 shares of a $50 stock for a $1.50 premium per share, you immediately get $150 in your account. Do this across several positions and you can see how it builds a real income stream. Step 5 is you have to manage the outcome at expiration. So when the expiration date arrives, one of two things are going to happen. Outcome 1, the stock stays below the strike price, and this is usually what you're hoping for as an income investor. You want the ability to keep the stock while also double dipping and collecting the option premium. So, if your $50 stock is trading below the $55 strike price at expiration, maybe it's 53, 54 bucks, the option expires worthless. The buyer has no reason to buy a $53 stock from you for 55 bucks. So you keep the premium, you keep your 100 shares in the stock, and you're free to sell a new call for the next month. That's best case scenario, and that's really how you generate recurring retirement income. Outcome 2 is when the stock price rises above the strike price. If the stock has a fantastic month or 2 months or whatever it might be, depending on when your expiration date is, and let's assume it rises to say 57 bucks, the buyer will likely, they don't have to, but they will likely exercise their option to buy your shares at 55 bucks because the stock is now $57. So it's a good deal for them. Your shares will be automatically sold. You still keep the $1.50 premium you collected, so your total sale price is effectively $56.50 per share. Okay, that's the 55 they bought it for plus the $1.50 premium. So you've locked in a pretty nice profit, and your next move is to take that cash and either buy back into the stock or find another one so you can continue the process. Step 6 is to monitor and repeat. This is not a set and forget strategy, but it doesn't require you to be glued to your screen 365 days a year either. It is a methodical monthly process. It does require some hands-on work of reviewing your positions, selling new options, and managing any stocks that were called away. Now look, if you're finding this step-by-step breakdown helpful, do me a favor, hit that like button. It really helps the channel reach more people who are looking for smarter ways to fund their retirement. And be sure to subscribe so you don't miss out on future videos on practical income strategies and much more. Now, I promised you full transparency, and this is critical, it's important. No investment strategy wins in every single market. And anyone who says otherwise, they're selling you a fantasy. This strategy is designed to lag in one specific environment, and that is a roaring, face-ripping bull market. And by a roaring, face-ripping bull market, here's what I mean. I'm talking about the years where the market is up 22, 27, 35%. That's what I would consider a face-ripping bull market. So let's go back to our example. You own a stock at 50 bucks. You sell a call with a $55 strike, and you got your $1.50 premium, your $1.50 premium. Your maximum profit is capped. You can make $5 in share price gains from 50 to 55, plus the $1.50 premium on top of that. So the total is $6.50 per share, and that is a fantastic return over the course of 30 or 45 days, even 60 or 90 days. That's still a great return. But what if the market goes on an absolute tear and the stock rockets to 70 bucks? Well, because you sold that $55 call option, you have to sell your shares for 55 bucks, even though they're currently trading at 70. So you're going to miss out on all the extra upside from 55 to 70 bucks. The person who just held the stock is going to have a much bigger gain. That's why they're willing to partake in this kind of a strategy on the opposite side of you. So your upside is capped. And look, this is not a flaw. It's the fundamental trade-off. You are deliberately trading away unknown explosive upside in exchange for a known, very predictable upfront cash payment. And for any retiree whose main goal is reliable income in retirement, that's often a very smart trade. Here's how it performs in other markets. In flat or sideways markets, that's the sweet spot. The stock price doesn't move much, your options expire worthless, and you keep pocketing the premiums. In slightly rising markets, so we're talking about high single-digit returns, we're talking about low double-digit returns. So in years when the market might do a positive 8% or a 15%, those are slightly rising markets. You're also going to do very well here. You're going to collect the premium plus some modest gains in the stock. In down markets, whenever that return of the market is negative, whether it be -5, -10, -20, this strategy provides one heck of a cushion. The premium income you collect, it offsets some of the drawdown in the stock. So if the stock drops 5%, but you collected a 2% premium, your net loss is only 3%. However, that premium won't save you in a steep crash. If the stock plummets, you still lose money, just slightly less than if you had only held the stock. So to be clear, this is a strategy for prioritizing consistent income over maximizing growth. You have to be okay with lagging the S&P 500 in years when it might be up by 25%. But in the flat, in the down, in the moderately up years, which happen all the time, this strategy is built to shine. Now, there's really 3 different ways you can do this. You can write this on your own stocks, and it's going to require some labor, some work. You can hire a wealth manager like us, and we identify the stocks that we want to own, and we will write the covered calls on them. Or you can opt for using a covered call ETF. I mean, look, I get it. For some, managing individual options, even with this video guide, it might seem like a lot of work. And what happens if you forget to sit down 30 or 45 days later and rewrite all of your options? So the good news is there is a much simpler hands-off way to do this, and that would be covered call ETFs. So these are funds that are traded daily that do all the work for you. So the fund manager, they own a basket of stocks, often mirroring an index like maybe the S&P 500 or the NASDAQ 100, and they run the covered call strategy on your behalf. They sell the options, they collect the premiums, and then pay that income out to you, usually as a high monthly distribution. Now, these funds have become incredibly popular for a few good reasons. Number one, simplicity. You can buy just one ticker symbol and get instant exposure. You don't have to worry about sitting down every 30, 45, 60, or 90 days, and you don't have to manage those individual options. Number two is diversification. So instead of needing enough capital for 100 shares on multiple stocks, you can get diversification across hundreds of stocks with a single share of an ETF. Number three is high distribution yields. These ETFs are known for attractive yields. I mean, there's a lot of positions out there that are showing yields in the 7%, maybe up to 13% range in recent years. By the way, if you'd like information on which ETFs can actually do that for you, make sure you comment below and I'll make sure to reach out to you and give you some of that info. Now, of course, the same trade-offs apply. These ETFs will also cap your upside in those strong bull markets. You also pay a management fee, and it's crucial to understand exactly what you're getting. So those high monthly payouts, they're not guaranteed, and they can be a mix of option premiums, dividends, and sometimes return of capital, which is essentially the fund giving you a piece of your own investment back. It's likely going to be those stocks that were called away. Now, this is not the same as pure profit, and these distributions can have complex tax implications, which is why many people hold these kind of ETFs or funds, or run these strategies on their own, or run these strategies with a wealth manager in a tax-advantaged account like an IRA. That would be the most ideal place to do this. So the challenge of generating a safe and reliable income in retirement, it's more real than ever. The old ways, they just don't feel as secure as they used to. The covered call strategy, whether you do it yourself with stocks, whether you have a wealth manager utilize stocks and write those covered calls for you, or you use something much simpler like an ETF, this offers a powerful alternative. It shifts your mindset from one of scarcity, of having to sell off your nest egg piece by piece over time, to one where your assets are actively working to generate a monthly paycheck for you in retirement. It's not perfect. It's not a perfect strategy. Nothing is perfect. There's always pros and cons to everything, and you have to accept the trade-off of capped upside in exchange for that higher, more consistent income. You're trading the possibility of spectacular gains for the predictability of cash flow. For most retirees I've worked with whose top priority is peace of mind, that's a trade they're more than willing to make. This strategy helps turn your portfolio into an income machine. It reduces volatility, and it gives you the confidence to enjoy the retirement you worked so hard to build. Your retirement journey is unique, and a solid income plan is the cornerstone of a successful one. If you're looking to design a personalized strategy for your needs, there's a link in the description where you can book a consultation with my team. It's tepperzoom.com. We can help you figure out if a strategy like this is a good fit for you. Also, be sure to watch this next video on the screen where I break down the bucket strategy to further protect your portfolio. Thanks for watching, and I'll see you in the next video.